Okay, I want you to put your investor hat on. You're thinking about buying equity or a share of stock in a firm called Southern Company, which is a utilities firm that provides energy and electricity to its customers. If you buy a share of equity in Southern Company, you'll have a lot of partners. There are more than 900 million shares of equity outstanding. But it's a big company with revenue at roughly $20 billion a year. So if you own a share of equity in Southern Company, what do you get? Well, you get a right to vote on matters that come up at the company's annual meeting, and you also get your fair share of the company's profits. Some of their profits are reinvested back into the company, and some are paid out as dividends or cash to you and the other shareholders. Southern Company paid out about $2.25 in dividends in a recent year. So if you own a share of equity, you would have gotten a check in the mail for a total of $2.25. So based just on that, how much would you pay for your one share of equity? For example, if you had paid $10 for a share of equity, then you would have gotten a rate of return of $2.25 divided by $10, or 22.5% for the year. And this is just the cash return. You might also hope that the price of the equity goes up over time as well. 22.5% is very, very high for a mature company in a fairly low-risk industry with a strong market share and some growth prospects. A company's rate of return should be commensurate with its level of risk, and over 20% might be expected from a startup, but not from a firm like Southern Company. Say investors expect a rate of return of 10% per year from the Southern Company. Then does this change what you would pay for a share of their equity? Of course. And since you receive $2.25 per year, you would be willing to pay roughly $22.50. In other words, you pay $22.50 and receive a rate of return of 10% in the form of a dividend. To be honest, even 10% is high in a low interest rate environment. Something closer to 5 or 7% is more accurate, so call it 6% just for this example. How does this translate into a price? Simply divide the $2.25 dividend by 6% and you arrive at $37.50. Seems simple, right? Note that we did have to make two assumptions here. The first is that 6% is the correct rate of return, and the second assumption that is baked into this is that the $2.25 dividend will not grow over time. If it's expected to grow, even by a little bit, then we need to modify our math. Say, for example, that you expect the dividend to grow by roughly 2% per year. So next year's total dividends will be $2.25 plus 2%, or roughly $2.30. But now, instead of dividing by the straight 6% rate of return, we instead divide by 6% minus 2%, or 4%. If we wanted to talk about the math underlying this, we would discuss finding the limit of a geometric progression. Yikes. Instead, we simply divide next year's expected dividend by the expected return minus the growth rate. So in this case, $2.30 divided by 4%. This would give us a value of $57.50. If we compare this against Southern Company's equity price, we see that it is hovering around $50 at the moment. So we're not actually that far off. Of course, there are a lot of complicating factors in here that will involve whether they will continue to pay out at the same rate, whether they will grow at a rate in the future similar to the past, and whether investors will consistently expect a rate of return of 6%. So we would need to continually calibrate and refine our estimate. Also, there's a more complex version of this that involves multiple possible future growth rates and additional variables. But overall, this gives you a good flavor of one method of valuing stocks and equity called the discounted dividend model. There is a more common method called relative valuation. In this method, we use a set of peer companies to compare against the one that we're interested in valuing. The process goes something like this. I'll use real estate for an example. Say your next door neighbor just sold their house for $500,000. You're thinking of selling your house. What's the best estimate for what you could sell your house for? Well, why not just say $500,000? Maybe their house is 5,000 square feet in size, and your house is only 4,000 square feet in size. Now you see how we can calibrate the neighbor's house price against the size differences. First, estimate the price per square foot of the neighbor's house. $500,000 divided by 5,000 square feet means that someone bought the neighbor's house for $100 per square foot. And second, since we have 4,000 square feet in our house, the best estimate for our house's value, given the information that we have here, is 4,000 times 100, or $400,000. So what process did we just use here? We found a metric that explains something that drives value, square feet of a home. Then we found a similar home and computed the metric for that similar home, then applied that metric to our own home. For equity, there are a few acceptable metrics that are common. One of the most common is a price-earnings ratio. A price-earnings ratio, also called a PE ratio, reveals what investors will pay for every dollar of earnings. For example, Duke Energy, a company that is comparable to Southern Company, has a price-earnings ratio of 22. This means that investors are willing to pay $22 for every dollar of earnings that Duke Energy makes. Now let's take that PE ratio and apply it to Southern Company. Southern Company's earnings per share of equity were recently $2.55. So now we apply the comparable firm's PE ratio of 22 to Southern Company's earnings. 22 times $2.55 gives us $56.10, pretty close to what a share of equity in Southern Company is selling for, and not far from the price that the other method gave us as well. It will never be exactly the same, and our goal is to triangulate the value. That is, try to figure out what the highest and lowest values would be that we would be comfortable with, and if it goes above or below, then we would use that as a signal to either buy or sell. You might be asking, can it be this simple? And the answer is yes, it can. But know that the models that investors use are just a little bit more involved and employ multiple ratios and methods, as well as use a deeper understanding of what drives the values in order to find what a share of equity should be worth.